is part of Chapter 5, the Chapter 5 assigned reading. In Allocation and Marcus, they actually have you work problems where they find out the relative risk aversion that investors have, and they try and say, okay, well, what does that mean for where their preferences are? I take a more conceptual approach to it. I think understanding what it means is important, but I don't necessarily think me telling you, okay, well, what is that ratio? I don't know if that's actually useful, but understanding how risk aversion works, I think it's really useful. So now it's important to note in Allocation and Marcus, they use this risk aversion ratio here. It's the excess return of a risky asset or a risky portfolio over the risk-free, in excess of the risk-free rate, divided by the variance of that risky return. Investors do not like, and just people in general do not like risk. We do not like uncertainty. And so we tend to say, well, if I'm going to have to bear more risk, you're going to have a much higher expected return. I don't want to do that. So they call this the price of risk here, this ratio. Variance, not standard deviation. And to talk a little bit more about risk, I do want to take a moment. I'm going to introduce a few concepts about behavioral finance now. We will talk about it again later. But I do want to get you thinking about risk. How do you perceive risk? How do economists and people who work in academic finance research groups and academic departments, how do they think about risk? In traditional economic theory, there's a mathematical way to describe an individual's preferences for consuming goods based on their income level. The big assumption is that you assume that individuals are rational. They have a utility curve that they maximize. Literally, economists say, well, they maximize by taking the first order conditions, using calculus, setting those equal to 0, making sure that they're at a local maximum by taking the second order conditions and making sure that they have what's called a, for a maximum, then that would be a, forgotten about it. I can't believe I forgot the term. It's a matrix math term. So it's monotonically increasing. So it's quasi-non. Oh, shoot. That's going to bug me for a while. You can see how it's silly. The point is that assuming that individuals make all these mathematical steps is silly. But the concept is that the curve that they have, if they have, given any level of income, they will choose to optimize their utility by spending it accordingly. So that means that for any associated income, they have a utility curve that is upward sloping. It's always increasing as you get more income, but the slope decreases as they earn more money, decreasing marginal utility of income. Now, this utility curve has embedded in it already risk aversion. And if you're wondering how does that work, let's take a risky outcome, a risky venture for an individual who's facing a very extreme high level of income and a very extreme low level of income. And let's just assume that it's about a 50% gamble for them. 50% they'll be at the high income, 50% at the low income. The associated utility levels are right there on the screen. If you look, that line needs to go all the way across. If you look at this dotted line, expected utility is the midpoint, 50-50, of the dotted line. you take the expected value of the utility, not of income. I mean, that issue where I've lost my cursor now. If you look at the difference between the income that would guarantee this individual will get their expected utility and the expected income itself, which is a different thing. Taking the expectation of income versus taking an expectation of a function of income. You get two different values. That difference between what's called certainty equivalence, the level of income that you could guarantee an individual will have the same expected utility as opposed to them taking the gamble. That's the certainty equivalence. The difference there, that should actually be insurance companies' revenues, but you get the idea. This was one of the first things that I learned in microeconomics in graduate school is the elements of risk aversion tied to this gamble and how insurance companies take advantage of this by charging a little bit more. And they seek, it's called rent seeking, economic rent seeking. Essentially take advantage of an individual's risk aversion. There's a lot of problems if you have this low of an income and you only have one or two shots, as opposed to an insurance company aggregates it up across hundreds of thousands, millions, tens of millions of covered individuals. So that's the element of risk aversion embedded in this kind of an approach to economic thought. And so this curve overall does a pretty good job of mathematically representing how individuals make their decisions most of the time. Most of the time. There are a few exceptions. Now, in the late 70s, two behavioral psychologists in Israel, Daniel Kahneman and Amos Tversky, were very interested in how they like to study how normal people make decisions. What was they like? They didn't like to study these extreme cases when you think of psychology. No, they were interested in just normal people. How do we make decisions? And they came up with an idea that they called prospect theory. And prospect theory, rather than having a utility function, has a value function. And this value function in the upper right quadrant looks very similar to the utility function that traditional academic economists use. But there's a switch. There's a change in the way that we perceive the results if we frame the outcome rather than gains as losses. So if we perceive the outcome to be a loss incurring venture, we're either going to incur a smaller loss or a bigger loss. We actually start to behave differently. Not only that, it's the change in the way that these curves are curved. The one in the upper right quadrant that is convex down, the one in the lower left quadrant is convex up, or concave up. They noticed this pattern over and over again. Not only that, they also noticed that the perceived pain of a loss versus the perceived benefit or enjoyment of a gain that was the same dollar amount had different strengths of impact, different magnitudes of impact. So they came up with this idea of, rather than risk aversion, loss aversion. Think of the pain if you have a, let's say you have a $50 bill in your pocket. Well, let's start the other way. You're walking down the street You're in a park, on a walkway in a park. There's nobody around. You look down. There's a $50 bill on the ground. You pick it up, look around. There's no one there. You think, oh, well, I looked. Put it in your pocket, walk away. You feel pretty happy. Maybe you'll go out and have a nice meal sometime soon. On a completely different day, you go to the ATM, you take out some money of the $50 bill, you put it in your pocket, and you go about your business throughout the rest of the day. You get home in the evening, and then you reach in your pocket for that $50 bill, and it is not there. It is gone. The amount of frustration that you are likely to feel from not knowing where that $50 bill is. Did I leave it in my bag? Is it in my jacket? I was sitting on the couch earlier. I went and pull up all the cushions and look for the under the couches. The perceived pain of that losing that $50 bill is stronger. It's a stronger motivator than the benefit, the feeling of enjoyment you get when you found that $50 in that other instance. And this is something that they actually tried to estimate, and they found that it was about twice as powerful, no matter how they estimated it. And they did go through studies to try and estimate how powerful of an impact does it have. It's about twice as powerful. So let's use an example. I think there's a comment in here. You clearly entered a time travel paradox. Not sure what that's a reference to, but just quickly, let's do a quick example, and I do want you to participate. So I'm going to offer you a choice. Very funny, Jason. I appreciate that humor. I needed the explanation, though. All right, so I want you to consider these. I just want you to use the annotations quickly. Just answer. Right? Just whichever one you feel like you would choose right now. So gamble A, 95% chance you would win 15,000. Are you able to use the annotations? So I want to see them on the screen. So if you go to annotations. Is there a way to do like a stamp, a check mark? So I'll use mine. I'll go ahead and put mine there. That's mine. So who would choose gamble A? Put your check mark somewhere around gamble A. Who would choose gamble B? Put your check mark somewhere around gamble B. So 95% chance of winning 15,000 or 5% chance that you would win nothing. Gamble B is you have a 100% chance you would get 14,000. Just boom, you don't have to worry about it. Risk-free, done. See, people have entered in the chat B. People have, entered, checked B. Okay. Remember your answer, and we're going to do the same thing again in just a moment. But it's very clear just from looking at this quickly, this risk aversion concept, right? And usually more people put, on average, more people, notably more people, choose B. All right, let me clear out the annotations. Oh, sorry. Didn't mean to do that. All right, slightly different. Gamble Y and gamble Z. Gamble Y, you are going to lose. So think about it, me. Where you're playing a game with me. You owe me $4,665, or 95% chance that you will lose $5,000, 5% chance you will lose nothing. Quickly answer which one you would choose. Oh, I've lost my cursor again. Okay. Whoops. It looks like people are choosing the Z a little bit more frequently. Don't have anyone choosing Y. I'm going to clear out the results here. I want you to notice something really quickly. In this example, you have become risk-seeking. You have chosen a risk, because everyone that answered chose Z, and I'm presuming that many of you changed. You had, your answer was the certainty before, I think that was gamble B, and you've chosen now the risky gamble Z. Does anyone want to go ahead and claim that they did in fact switch from a certain outcome to a riskier gamble?
Sure did.
Yeah. But notice something about the payouts here. The expected payout or loss from gamble Z is 4,750. So not only have you become riskier, you have chosen the one that has the higher magnitude of loss. And so because of these behavioral outcomes, Kahneman and Tversky said, there's something going on here that's peculiar. I'm shorting this game. Good for you. I wish you could do that. Now you might be thinking, well, I would never choose, even enter into any kind of gamble where I would have a loss. Well, think about it from, well, I'm sitting on my investment and I'm already down 8%. I just want to get back to even. I just want to get back to even. I want double or nothing. I'm rationalizing. I have that chance that I might not owe anything. I might get back to breaking even. That's exactly the point that Kahneman and Tversky were trying to make. That's the exact behavior that they were trying to model by using this. And there's lots of aspects of behavioral finance. Framing. Are you framing it as I'm already sitting on a loss? Or are you framing it as I have the opportunity to make this money grow? That's going to change your decision-making process because we take these shortcuts. And those are called behavioral biases. The shortcuts themselves are called heuristics. We have these very difficult decisions that we make, and we have a limited amount of time with which we can make them. Even sometimes we have a fairly abundant amount of time to make those decisions, and we still fall victim to these behavioral biases and these heuristics. We have things like, we have bounded rationality. We can only understand or comprehend so much and in such a short amount of time. These shortcuts are what lead us to make sometimes poor decisions. And there are a few chief heuristics that they came up with. So one is availability. What is the easiest thing for you to think of that seems to pertain to your current decision or problem or challenge that you're facing? And it's different for every person. There's also a representativeness heuristic that also has a representative bias that's associated with it. Oh, you're talking about this phenomenon? Well, I have personal experience of something that exactly matches that, what we're talking about, and this was the outcome. So this will be representative of the best thing to do. One of the ways that they tested this was that they would actually have little biographical information about two people. And they play on biases. So they're also going to play on things like gender biases. They have Jane and Maggie. Jane majored in literature, and she really enjoys kind of quiet thinking time, and she walks on the beach, likes to take walks alone. Maggie is a very outdoorsy person. She likes to go on hiking. She's part of the Sierra. She's a member of the Sierra Club. These are not exactly, but very close. Is it more likely that one or the other of them is a bank teller and one or the other of them is a librarian? Which one is more likely to be a bank teller? Jane or Maggie? Which one is more likely to be a librarian? Does anyone want to guess? And I know this plays on biases, that's the point. These were very similar to the examples they gave. The correct answer is they're both much more likely to be bank tellers. Just through sheer numbers. There are so many more bank tellers than there are librarians. This was they used that example. The Sierra Club was part of it. The major, what college major they had. And it has nothing to, the information that you are given actually in reality has little to no bearing on the probability of whether or not they have one career or the other. But that's the point, is that they were highlighting that we have these biases. And I think that they hadn't, I don't know that they intentionally hit on the gender bias. That just happened to be the examples that they gave. But I think that has probably a profound impact today. Again, this was back in the 1970s that they were doing these experiments. And people come up with ways to rationalize their decisions, shortcuts that they take that lend them to or lead them to poor decisions. So we're going to come back to behavioral biases. I obviously am fascinated by them. Over the last several years, they've played out, I think, in somewhat disastrous fashion. And they've been playing out for decades, centuries in disastrous fashion. In my personal opinion, the only way to combat that, first, you or we all have it incumbent upon us to actually recognize those biases before we can actually do anything about them. Even recognizing them is hard enough. Actually changing behaviors, obviously, is even more difficult. Any questions, comments? Okay. So I'm going to talk a little bit about portfolio allocation. This kind of gets a little bit ahead of Chapter 5. In Chapter 5, the Bodie and Marcus kind of throw out this capital allocation line. But it's not really clear where they come up with it. You have a risky portfolio that has, return of R and standard deviation return of sigma or S. And so I'm actually going to throw out, the concept of the efficient frontier. This gets into a little bit more of Chapter 6 kind of characteristics. If you optimize the entire universe of available investable assets, and there are actually tools that try and estimate this that lots of different companies use, but you can come up with a way of, okay, well, here's kind of the schedule of returns and risk that I would have to bear to get those returns that give me the best bang for my buck, the highest return for any given level of risk. That's called the efficient frontier. And it looks like this. So for any given level of risk, I can get up to that amount of return, but not higher. I wouldn't really want to accept a lower level of expected returns, because obviously if I'm taking the same amount of risk, I'll always want to gravitate towards the higher return potential. The risk-free rate, I put a phony risk-free rate on this graph. That's just, think about T-bill yields, treasury bills. That's the best risk-free rate you can come up with, right? So if I can invest in risk-free rate or somewhere on the efficient frontier, that blue line, I can also invest any combination between the risk-free rate and whatever I want to choose on the blue line. But I obviously would not want to choose anything that is below this gray line. This gray line is the capital allocation line. So if I have a portion in the risk-free asset, but a little bit in this portfolio here, whatever that is, where it only intersects at one point. There's one intersection point. It's called the tangent line, the point of tangency. I can combine any weighting between the risk-free rate and this portfolio, right here. Let me see if I can mark it with my annotations without causing any problems. Somewhere right around there. I can invest 100% into the risky portfolio at that point of tangency, or 100% the risk-free rate, and anywhere in between. And look at this, I can even go beyond that. What does that mean? What does that mean if I go beyond the point of tangency? Somewhere, let's say, up here, on that gray line. How could I do that? How could I actually get higher return? But still, I'm taking higher risk as well, but it's above the efficient frontier. Glitchy thing going on with my allocation. I'm borrowing money. Go back. I'm borrowing at the risk-free rate and investing it in that risky portfolio at that point of tangency. So I have a negative allocation to the risk-free rate and an allocation greater than 100% into that risky combination of assets. Now, this is theoretical because it assumes you can borrow at the risk-free rate, which is not accurate. But it does point out you can, in fact, use leverage in this framework. It's not perfect because it doesn't provide for credit costs of using leverage, which obviously there should be. If you look at the slope of this line, the capital allocation line, it is this formula here. That's the Sharpe ratio. And all of this comes from portfolio theory from decades ago. And it's funny because they call it modern portfolio theory when the first papers that were written about it were in the 50s. So it's really kind of fascinating. We still call it modern portfolio theory. But this is the concept, this is the idea. The slope of this line, the capital allocation line, which intersects at the risk-free rate and at the point of tangency of what's called the efficient frontier. Bodikane and Marcus in chapter 5 start with just assume that there's a risky portfolio that you can invest in that's efficient. And this is all theoretical, of course. So any combination between the risk-free asset and the efficient allocation on the efficient frontier would put the actual allocation along this capital allocation line. Now there is another version. It's called the capital market line. And that's just when you are using the risk-free rate and some large benchmark equity market index, like the S&P 500, Russell, one of the Russell indices, NASDAQ. And when we're dealing with an investor, investors are going to have preferences for risk and return. And we're going to return to traditional economic view again. So does everyone remember what an indifference, does anyone not remember what an indifference curve is in economics? I take that as a no. I'll do a brief reminder just in case. So in the course in economics, an individual or an investor maximizes their utility. They have a utility function, or sometimes they have a loss function that they're trying to minimize. Whatever the case may be, they come up with a schedule of combination of, for a consumer, it's a combination of goods, good one and good two. For an investor, it's a combination of risk and return, where as long as they are along that risk return schedule, they are equally well off. They're indifferent between any point on that curve. And so they will essentially try and figure, okay, well, what indifference curve do I want to be on? And these indifference curves, as you move up to a higher indifference curve, that is associated with a higher level of utility. So this highest utility indifference curve is unattainable. It is above the capital allocation line. You cannot achieve that in this market with this risk-free rate and this efficient frontier. Now, the one at the bottom, you can attain that, but look at all this space. You have 2 points to choose from, and also you've got all these points that are way above the indifference curve that obviously you would be better off taking one of those points instead of anything that's on this indifference curve. So you continue to shift the indifference curve up and up until you only intersect the capital allocation line at 1 point. Again, a point of tangency, where the slope of the capital allocation line and the indifference curve are the same, and the indifference curve only intersects at that 1 point. And this is that concept of investors trying to maximize their expected utility. When we're not looking at goods anymore, we're looking at the trade-off between risk and return. And that's essentially what Bodie-Kanan markets are getting at, and any investment books eventually gets to when they're talking about, well, what are the goals? What is the risk aversion, issue? And so they have all these. I'm trying to look at the actual page where they talk about it, because here we go. Risk premiums and risk aversion. My version, it's page 123. Then there's a line graph in here. On page 132, they have this graph of the capital allocation line. They say, well, where would an investor be if their risk aversion ratio was 0.25 or something? And this goes to, in terms of a matter of practical application of investments, that doesn't seem to be very realistic. Kind of flies in the face of how people actually make decisions. But that's the way academics approach modeling these problems, asking and analyzing these problems through the lens of these mathematical equations. And while they don't really, in practice, the academic researchers don't really focus on the actual values, they do focus on these things like, well, are we at the point of tangency? And how do we model decision making when we create all these representative agents who are essentially trying to behave the way that we want them to in this vacuum model that we're working on? Any questions about this? Comments, concerns? You probably weren't thinking today that you were going to come into class and hear me talk about gender biases. Sorry if I offended, I didn't mean to. I'm trying my best to highlight the research, but also acknowledge shortcomings of the research. Okay. Trying to decide if it's best for me to stop here. Let me pause the recording.